All right, my friends, this video is going to take a lot of people in my business off. And I'm sorry, I'm just here to bring the truth. And this is about a variable annuities. Man, fees on top of fees on top of fees. It's painful to behold. And I'm going to dive right into one here today from New York Life. And look, it's New York Life. I mean, they're all pretty much the same thing. And the fees are just phenomenally expensive. It's nuts. And it's wrong. I don't know how else to say it. It's wrong. You're making the professionals rich on your own money. And I'm going to show you exactly what I'm talking about here. This is crazy talk. And so I'm going to do another video. I'll go down to the whiteboard here in just a second when I'm done with this and lay out a variable annuity I'm looking at from one of my guys who hired me for retirement planning advice. And I sit there and I just shudder to think at the fees how many people are getting fees off your hard-earned money. There's just no other way around it. So welcome to Heritage Wealth Planning, the place where I hope you come to hear the truth. I mean, my goodness, I don't have all the truth. You don't have all the truth, but putting our heads together, we can have a pretty good gauge of what's happening out there. And variable annuity is it's just one of those things that, man, don't default to them. All right, so let's go into this. Subscribe, and of course, thumbs up and comments. All right, so this guy, he took out a New York Life Premier Plus variable annuity in 2015, and it's no longer available. So this contract itself is no longer available. You can still make, I think actually I don't want to do that because this has an area I want to show you. I think you can still put money into the contract you already hold, but the contract as it were in 2015 when this guy bought it, you cannot go out there and buy. All right, so the first thing you got to know on all variable annuities is they got lots of charges. So here's a table of fees and services. That's page 23 of 42. So let's go to the front here, page 23 of 42. And I'm going to show you, this is a supplemental dated prospectus dated October 2018. And I want to show you the prospectus. Okay, this is just a change. So let's go back to page 23. I thought that might give you the heads up on it. Actually, maybe they do here. Do they? Hold on just a second. The supplemental did. Okay, this is just the amendments they've done here. New York Life Insurance, variable annuity policies. All right, I don't care. So I just want to show you first and foremost some of the fees that are in here. All right, so tables of fees and expenses. Guaranteed maximum surrender charge is 8. Now you can avoid that if you just hold the contract for long enough. Guaranteed transfer fee is $30, and I don't even know what that is. Guaranteed maximum charge on transfer fee, is that transferring out of the annuity? They're going to charge you $30, and that in and of itself isn't huge relative to some of these other firms do. Like, some of these big wirehouses, like $150 per account. I find that unfathomable. Let's see. And then it says in payment years 3 and beyond, the percentage applied to calculate the surrender charge is reduced. All right, whatever. Let me see if I can make this a little bit bigger. There we go. The next table shows the fees and expenses you will periodically pay during the time you own the policy, not including the fund fees and expenses. All right, so here we got M&E charges, which is mortality and expense. The charges and accumulation value-based M&E charge policies apply to you apply if you chose to have M&E charges calculated as an annualized percentage of daily average variable accumulation values, which I can almost guarantee you most people have. So the premium-based charge, M&E charge policies is $30. I don't even know what that means, but current and guaranteed maximum M&E expense is 1.65 or 1.75, however you choose it. So, I mean, that's for every $100,000 you have in this account, they're charging you 1.65% or $1,650. Every $100,000, $1,650. Now, that does not include the fees that you'll get on the investments as well, which I'm going to dive into here. I mean, 1.65. Now, what does M&E do? It guarantees a death benefit. I mean, that's literally what a mortality expense charge. They say at the end of the day, New York Life needs to make enough money from your account in which to provide your heirs a death benefit on the principal that you put in. That's it. So in this case, the guy dropped in $250,000. So the mortality expense says, no matter what happens, if you have no distributions out, we're going to guarantee your heir gets $250,000. And that would seem good if you dropped it in October 2007, because now all of a sudden the account's down to 180 or something like that, and you get hit by a bus, and then your heir is going to get 250. That's great. And that one time, that's it though. That's it. I mean, I'd just say in that case, just buy some CDs if you're worried about that short term, or just buy a small life insurance policy, because this M&E expense does not go away ever. It stays with you forever. And it's not based on the initial premium. It's based on the asset value. So you got premium-based M&E charge 1.75, and you got accumulation value-based M&E charge 1.65. So it's based on the asset value. As the more the account grows, the more you pay for M&E charges, and the less it actually pays anything, because the more the account grows, the more you have, you don't have any death benefit. Think about it like this. I start with 250. Account's worth 350. Is there a death benefit there? No. Why? Because if I die, my wife or my husband gets that 350. So why is I paying 1.65 on 350 when there is no death benefit inherently? There's none. Yeah. Now, I'm not sure the difference between premium-based M&E charges or accumulation. My presumption is that they're going to charge you 1.75% a year just based on that premium you put in, not based on the accumulation value. So if that's the case, you're saying, well, my premium was 250, now it's worth 350. I'm only paying 1.75 on that 250. Not 1.65 on the 350. Nuts. Insanely expensive. Either way, it's insanely expensive. All right, now here's some of the additional charges on top of the 1.6. Guaranteed maximum investment protection plan rider charge for policy owners. That's selected before 2010, so that won't be applicable here. Guaranteed maximum, and see they raise the fee, guaranteed maximum investment protection plan rider for policy that selected the rider after 2010. So they raised it by 25% from 1% to 1.25. Literally, I have no idea what that is. Calculated as an annualized percentage of the amount that is guaranteed under the investment protection plan rider deducted on a quarterly basis. Investment protection plan rider. We'll have to maybe dive into that and see what that is. Let me write this down. Investment protection plan rider. Now that's on top of the M&E, by the way. Current investment protection plan rider applied after 2017, so they've dropped it to 0.8. And again, they're not allowing anyone to buy this contract. Specific contract this one guy had, so maybe on other contracts this is applicable. I don't know. So I don't know what those riders are, but either way, it ain't cheap. All right, optional riders, investment protection plan rider 2. So here's a number 2. So if you weren't confused by number 1, well, now you got a investment protection plan 2 rider. I have no idea what it is. And then the optional guaranteed investment protection rider. So this isn't the investment plan protection rider. This is just the guaranteed protection rider. And then they got optional rider charges, guaranteed investment protection rider, 12-year rider term, 20. I mean, I have no idea what those are. And you don't either. And I assure you, your agent doesn't either. So stay away from them. That's all I got to say about that. All right. Annual death benefit reset rider. All right. So here I'm familiar with the general rule of thumb on annuities is that the death benefit is the M&E. So you have an M&E charge. You say at the end of the day, I die, my spouse gets at least the minimum of what I put in or the contract value, whatever the maximum of what I put in or the contract value, whatever that is. And that's nice. Is that worth $1,650 a year on a $100,000 investment? No. But at least you have some protection there for sure. But now they got an annual death benefit reset rider where they say, hey, your account went from 250 to 350. So now we're going to charge you 1% a year to have the ability to reset that on top of the M&E rider, on top of the 1.65 or 1.75. So now your account's worth 350. Well, why do I have an M&E? Why do I have an M&E if I have a 1% annual death benefit reset rider? Well, because what's the M&E serve? Well, Josh, we have to make sure that the insurance companies can pay your spouse the greater of the current value or the premium you put in, or in this case, the annual death benefit reset rider. That cost me 2.65, 2.75%. That's friggin' nuts. That's nuts. What is that? And I'm going to show you again in my next video how nuts this is and how bad it is on your ability to grow in these accounts. Freaking insane. I'm sorry. I'm so, God. They're charging you 1%. That's $1,000 a year per $100,000 investment for your ability to reset your death benefit that says, look, I started with 250, it's worth 350 now. I'm locking in the 350, so no matter what happens, my wife is going to be guaranteed to get 350 at my death, minus whatever distributions I took out. So if I got hit by a bus before taking distributions, she will get either the greater of my 350, not the 250, because that 1% rider allows me to increase it on an annual basis because it says annual. She'll get the greater of the 350 or the cash account as it's worth at that time at my death. So why am I paying the initial M&E expense? It's current annual death benefit rider charge. If the oldest owner was age 65 or younger at issue. So is that on top of the 1%? And then current annual death benefit rider charge if the oldest owner was age 66 to 75 at issue. So does that mean it's 1% plus 0.3? Man, I have no idea. I mean, I just, my goodness. But I mean, it says right there, 1% and then the current death benefit annual rider charge. Oh, maybe they're saying, look, if you were not, well, that's 65 or older. I don't know what that is. I don't know if that's on top of it. I just don't know. That's a maximum annual death benefit reset rider charge. Calculated as an annualized percentage of the reset value of the last policy anniversary date, deducted on a quarterly basis for a detailed explanation. That's going to make my head spin. Current annual death benefit rider charge if oldest owner was 65 or younger at issue. So maybe they're saying we won't charge you 1% if you're 55 when you bought it. See, I doubt that's the case, though, because that would be they're going to be most likely increasing the death benefit each and every year as the markets go. But I don't know. Either way, it's so expensive, and I still don't get why you're paying that on top of the M&E. All right, so here's the ABDR, annual death benefit reset, plus IPP, which is the investment protection plan, or the investment protection plan 2, or the guaranteed income PR. I don't know what the PR is. Protection rider. GI, I imagine, is guaranteed income, and the PR has got to be protection rider. So the guaranteed maximum investment protection plan rider, annual death benefit reset rider package charge. The maximum is 2%. Does it calculate as an annualized percentage at the reset? Okay, so the maximum that you'll pay is 2% on that. Okay, but that's just for those two riders. And the M&E, which I was griping about before, isn't a rider, it's standard. And there's the M&E. It doesn't say you can. It's just that's insane expensive. I mean, it doesn't say that you can deduct this. You cannot not have the M&E, but you cannot you can choose not to choose these riders, these ABDR plus IPP stuff. Oh man, it's freaking insane. How does this enhanced beneficiary benefit rider? This is going to be variable annuities used to give you a 40% bump up for estate tax, but they charge you for that. And I imagine this is what this is too. Guaranteed maximum enhanced beneficiary benefit rider calculated as an annual percentage of the accumulation value. Again, the more your account grows, the more they're going to charge you. The current enhanced, okay, so this is what they're saying. The current charge is 0.3, but they can go to 1%. That'd be the max. I get what they're saying there. Okay, so the current beneficiary, okay, that's what's going on. It's still crazy talk. But 0.3 is what they're charging right now as of this being issued in October 2018. I imagine that's probably the same thing here. Current, okay. So instead of 1%, they're charging you 0.3 or 0.35. All right, okay. Give me a break. So between that, all right, so here they're charging the current investment protection plan with ABDR is 0.75. It's not 2%. So it's 0.75. So, hey, thanks, New York Life. New York Life. And on top of that, if you want the enhanced beneficiary, the current charge is 0.3. So let's just say you got those. You're still paying 1% on top of the M&E, which is 1.65 or 1.75. Expenses that are deducted expenses are deducted from the eligible portfolio assets, including management fees, That's minimum 0.45, maximum 2.74. So we're going to get into the expenses on that here in just a second. I might just do another video on that. Annual portfolio company operating expenses. Let's see. Can I flip this over? I can't. So we're going to do another one here about how the this is. Yeah. Well, oh man, can I flip this over? Previous page. No. Let's see if I can flip this around. I don't see how I could. Interview page, view of inspect. All right, so I'm going to show you how the fees can each live on the investment. So stay tuned here, my friends. All right, so we just started. We showed you how the fees are 1.65, 1.75 on the mortality expense. And we'll just say 1% if you choose additional riders. So right there, you're looking at about 2 3/4 fees just for the various death benefits and income guarantees. And those income guarantees, you're going to need them because you're not going to make any money on the upside. So let me show you what I'm talking about here in just a second. And for you, those who are literal, you're not going to make any money. You'll make a little bit. And I'll show you why you would have been better in CDs if you would have done this 14 years ago next time. But in an episode here. The next one, we're going to show you the fees on these expenses, on these funds that you can get. It's insane too. So just add fuel to the fire of why you should stay away from these guys. They're just ripe with fees, and there's 8 million different people getting their fees from you, and I just don't like it. All right, so stay tuned, subscribe, and we'll see you next time. Thanks, guys.